Okay, hi, this is Jin Yamamoto. Here's a stock valuation number 6. We deal with this time risk premium. Okay, what are the risk premiums? In stock investment, we have expected return. It's a certain level of return, roughly to say 10 to 20%, I would say. However, in stock investment, we have risks. What are the risks? We might have a negative returns. We might have a huge capital loss. And if you think about stock price movement, stock price rate of change, I would say rate of return, rate of change range between plus minus 2 sigmas standard deviation. Okay, I would say stock price fluctuate within 2 sigma. Typically, sigma would be 20% or 40%, and very risky stock, you might have a 80%, 60% rate of change of sigma, standard deviation. However, if you purchase lottery, you might suddenly get 1 billion or 1 million times a day. So I would say stock price movement is rather stable. It's more stable than, for example, my wife's feelings fluctuation. Okay. So what's the premium, risk premium? It would be compensation of loss. What's compensation? What we need compensate to you is you might get worse than expected return within 2 sigmas. And what are the most likely, most appropriate compensation level of loss? I would like to think about it. Because this triangle, I forgot to explain to you this triangle. The horizontal line shows you the level of returns you get. The left side, you get a worse than expected return. And vertical line show you the probability. Most likely, you will get expected return here, the center pole. However, you might get negative 1 sigma return or negative 2 sigma return here, but probability you're getting 2 sigma is almost 0, right? This is a triangle, and the area of this left side triangle would be a half, 50%, because the area shows you a probability. So probability you get was an expected return would be 50%. And where the center of gravity of this triangle, I set x, variable x, means the distance, distance you get worse than expected return from expected return. So here is a distance. And where's the center of gravity? You see smaller triangle here. I would show you the smaller triangle like this. And the area of this smaller triangle becomes a half of that area of the larger one. Would be the center of gravity, right? So, simple calculation. We set side length is 2 sigma and vertical length is h, and the area of the left side triangle 0.5 of probability. So side times vertical would be 1, area 1, right? So h, height, would be 1 over 2 sigma. And what about slope? Slope is angle. This angle, slope is this angle, and it should be vertical over side. So we get 1 over 4 sigma squared, right? So center of gravity would be, we can obtain from this equation, side of a smaller triangle, and height of the smaller triangle would be side times slope, right? So side times height. Height would be side times slope, right? So that should be 1/4. And we get x equals roughly 0.6 sigma. If you solve this equation. Okay, we get x should be, we get x, and x should be 0.6 sigma, right? And the center of gravity around here. So finally, we get risk premium. Risk premium would be 1 times 2. 1, probability of getting worse than expected returns, and 2, it's most likely loss, the center of gravity. So risk premium would be 50% of probability times center of gravity of 0.6 sigma equals 0.3 sigma. Okay? So homework for you, please assume some risk premiums for your specific stocks. And we can calculate risk premiums by time series of stock fluctuations, fluctuation sample, rate of change samples. Okay? See you soon. Thank you very much.